What if I told you that even after gold reached record prices, the majority of investors still own almost none of it? It sounds surprising, but the data suggests exactly that. Gold has been one of the best performing assets in recent years, yet the average investor barely holds any meaningful allocation. This creates a fascinating situation in the financial world. On one side, we see a powerful bull market pushing prices higher. On the other side, we see extremely low ownership among investors. When these two forces exist together, it often means the real move may still be ahead. In today's video, we are going to explore just how under-owned gold really is, why this matters for the global financial system, and what could potentially happen to the price of gold if investor allocations start moving back toward historical norms. And you're watching Gold Silver Scope, where we break down the biggest trends shaping the gold and silver markets. Many well-known investors and institutions have long argued that gold should play an important role in portfolio construction. Some believe investors should hold around 5 to 15% of their portfolios in gold. Others argue that the allocation should be even higher during uncertain economic conditions. The logic behind this idea is simple. Gold historically performs well during periods of inflation, financial instability, and currency weakness. Because of this, it can act as a form of protection within a diversified portfolio. However, when we look at real data from portfolio managers and institutional investors, we see something very different. Instead of holding 10 or 20% in gold, the average portfolio manager currently holds less than 2%. That is an extremely small allocation compared with what many experts consider reasonable. When you step back and look at the numbers, the gap becomes very clear. If investors currently hold around 2% in gold, but a more balanced allocation might be closer to 20%, that represents a difference of almost 10 times. Now, this does not necessarily mean that gold allocations will suddenly increase tenfold. Financial markets rarely move in such perfect mathematical ways. But it does show that there is enormous room for change. Even a small shift in investor behavior could create a massive impact on the gold market. Remember, gold is a relatively small market compared with many other asset classes. Because of that, when large amounts of capital begin flowing into gold, the price tends to move much faster. At the same time, we are also witnessing what many analysts describe as a major shift in portfolio construction. For decades, the traditional model for investors was the famous 60-40 portfolio. That means 60% in stocks and 40% in bonds. This structure worked well for many years because bonds provided stability and income, while stocks delivered growth. But the world is changing. Rising inflation, higher debt levels, and increasing economic uncertainty are forcing investors to rethink this strategy. Today, more investors are beginning to question whether the traditional 60-40 model still works in the modern economic environment. Bonds no longer provide the same level of safety they once did, especially during periods of high inflation. As a result, investors are starting to explore alternative assets that can provide protection against economic instability. Gold is increasingly becoming one of the most discussed options. Another important factor to consider is where investors currently have most of their money. Household portfolios today are heavily concentrated in equities. In fact, equity allocations have recently reached some of the highest levels ever recorded. In certain estimates, households now hold around 45 to nearly 50% of their financial assets in stocks. That is even higher than the levels seen during the famous dot-com bubble of the late 1990s. When allocations reach such extreme levels, it becomes harder for the same asset class to continue absorbing more capital. In other words, if investors already hold a very large percentage of their wealth in stocks, there is limited room for further expansion. Eventually, some of that capital tends to move elsewhere. Historically, when equity allocations become stretched, Investors begin searching for assets that offer diversification and protection. Gold has often played that role. This creates an interesting possibility. If even a small percentage of capital begins shifting away from equities and toward gold, the impact on the gold market could be dramatic. Because the gold market is much smaller than the global equity market, even a tiny reallocation of capital could multiply gold's price. And this is where things start to become very interesting. In the next part, we will look at what could happen to the price of gold if investor allocations increase only slightly. The numbers may surprise you, because even a small change in portfolio allocation could potentially drive gold prices far higher than most people expect. To understand how powerful even a small shift toward gold could be, we need to look at how asset allocations affect price movements. Large financial institutions often build models to estimate how markets might react under different scenarios. One interesting projection suggests that if household gold allocations increased from roughly 3% of assets under management to around 4.6%, the price of gold could potentially rise to somewhere between $8,000 and $8,500 per ounce. At first glance, this might seem surprising. The increase in allocation is relatively small, only about 1.5 percentage points. But because the gold market is limited in size, even a modest increase in demand could have a significant impact on price. When large amounts of capital chase a limited supply of assets, prices tend to move quickly. But there is another important detail that many traditional financial models often overlook. These models usually assume that price changes happen in a linear way. In simple terms, that means if demand increases by 50%, the price might also increase by roughly 50%. However, gold does not always behave in such a predictable manner. Historically, gold tends to move in powerful cycles that often become parabolic during major bull markets. In a parabolic move, prices accelerate rapidly as momentum builds. Investors begin to notice the rising prices, which attracts even more buyers. This creates a feedback loop where increasing demand pushes prices higher, and higher prices attract additional demand. If gold allocations were to rise by 50%, the resulting price move could potentially be much larger than what traditional models suggest. There is also another factor to consider. Large banks and financial institutions often publish conservative price forecasts. They tend to avoid making extremely bold predictions because their models are designed to minimize risk. That means the actual outcome during a strong bull market can sometimes exceed these forecasts. If gold allocations were to increase modestly across global portfolios, it would not necessarily require a massive shift of capital. For example, imagine household portfolios that currently hold around 45% in equities. If only a small portion of that capital moved from stocks into gold, even a shift of 1 or 2% could represent hundreds of billions of dollars. This is why analysts often say that gold does not need a huge amount of capital to move significantly. Because the market is relatively small compared with global equities, even a tiny rebalancing can have outsized effects. A small shift from stocks to gold could produce a very large price reaction. Another way to understand this dynamic is by comparing the total size of the gold market with the global stock market. When analysts chart these two markets together, they often measure how much of the combined value belongs to gold and how much belongs to equities. Over long periods of history, capital flows back and forth between these two asset classes. Sometimes investors favor stocks, and the equity market grows much faster. During other periods, investors move toward safe haven assets like gold. These cycles can last many years, and they often reflect the broader economic environment. When we examine historical data, we can see that the relationship between gold and equities tends to oscillate over time. There are periods when gold becomes relatively more valuable compared with stocks, and there are periods when stocks dominate. These cycles often correspond with major economic events such as wars, inflationary periods, or financial crises. Interestingly, recent data suggests that gold's share of the combined gold and equity market is currently close to its long-term average. That means, even though gold prices have been rising, the metal has not yet reached the extreme levels that often occur during major bull markets. In previous cycles, gold significantly exceeded its historical average before the trend eventually reversed. This suggests something very important. If the current gold bull market continues, we may still be in the early stages of the cycle. Historically, when gold enters a strong bull phase, it tends to outperform equities for several years. During those periods, capital flows increasingly toward gold as investors seek protection against economic uncertainty. And when this happens, the relative value of gold compared with stocks can rise dramatically. In some historical cases, gold's market share surged far above its long-term average. If similar conditions develop in the coming years, it could signal a powerful shift in global investment behavior. In the final part, we will explore the key economic forces that could drive this shift. From rising global debt to inflation pressures and limited gold supply, several powerful trends may shape the future of the gold market. To understand why many analysts believe gold could experience a powerful cycle ahead, we need to examine the broader economic environment. Several long-term trends are now unfolding at the same time, and many of them historically support higher gold prices. One of the most important factors is the rapid growth of global debt. Governments around the world have accumulated enormous amounts of debt over the past few decades. In many countries, debt levels are now reaching record highs compared with the size of their economies. When debt becomes extremely large, policymakers often face difficult choices. Raising taxes or cutting spending can slow economic growth, while printing more money can reduce the real value of debt through inflation. Historically, many governments have chosen the path of inflation because it is politically easier than strict austerity measures. However, inflation tends to weaken the purchasing power of paper currencies over time. During such periods, investors often turn toward hard assets like gold, which cannot be printed or created by governments. Another important trend is the increasing geopolitical tension around the world. Sanctions, trade conflicts, and political instability have become more common in recent years. In uncertain times, countries and central banks often look for neutral reserve assets that are not tied to the financial system of any single nation. Gold plays a unique role in this regard because it is universally recognized and cannot be easily controlled by any government. At the same time, many central banks have already begun increasing their gold reserves. Over the past several years, central banks have been some of the largest buyers of gold in the global market. This trend reflects a growing desire to diversify reserves away from traditional assets such as government bonds. There is also the issue of supply. Unlike many other commodities, gold production cannot be increased quickly. Discovering new gold deposits takes many years, and building new mines is an extremely expensive and complex process. In fact, global gold production has remained relatively flat in recent years, and major new discoveries have become increasingly rare. When demand grows but supply remains limited, prices tend to rise. This basic economic principle has played an important role in many previous gold bull markets. All of these forces together create a very interesting situation. On one hand, gold ownership among investors remains historically low. On the other hand, the global economic environment appears increasingly supportive of gold demand. If these trends continue, even a modest shift in investor allocations could push gold prices significantly higher in the years ahead. Of course, financial markets are never completely predictable. Prices can move up and down in the short term, and no forecast is guaranteed. But history shows that when economic uncertainty increases and monetary conditions become unstable, gold often plays an important role in protecting wealth. If you enjoy deep analysis of the gold and silver markets and want to stay informed about the major trends shaping the future of precious metals, make sure to subscribe to Gold Silver Scope and join our growing community of investors who are looking beyond the headlines and focusing on the long-term opportunities in gold and silver.